Whereas Chapter 2 focused on the balance sheet, Chapter 3 focuses on the income statement. It starts off with a discussion about the operating cycle. The operating cycle, or namely the operating activities within the operating cycle, are the primary sources of revenues and expenses. And as we know, revenues and expenses make up the income statement. Essentially, the activities within the operating cycle encompass the time that it takes for a company to acquire goods and services from suppliers or vendors, and then ultimately turn those goods or services into goods or services that are sold to customers and ultimately collected for cash. Key portions of these operating activities are ultimately going to be shown on the income statement through revenues and expenses, and those are going to be our focus for today. So in focusing on revenues and expenses, it's going to be really important to determine what drives the transaction being recorded, and ultimately that's going to lead us to a discussion about accrual basis accounting, which is what we're going to focus on right now. In determining when to record revenues and expenses, you can say that general accounting offers us essentially two choices. We could utilize what we refer to as a cash basis accounting, or we could utilize what we call accrual basis accounting. Ultimately, to cut to the chase, I'm going to tell you there's only one acceptable method under financial accounting rules, and that's going to be accrual basis accounting. But it's important to distinguish between the two so that you understand how accrual basis accounting works and avoid any common pitfalls that students sometimes run into by thinking along the lines of cash basis accounting when attempting to actually do accrual basis accounting. Okay, the important point to know about cash basis accounting is that revenues and expenses are driven by cash. Again, we're not that creative coming up in names and accounting. So it's cash. Cash coming in is going to be revenue. And again, this is from the company's perspective. Cash coming in is going to be revenue. Cash going out is going to be expenses from a cash basis perspective. From accrual basis perspective, that is not the way we interpret revenues and expenses. Instead, revenues are going to be driven by what we call the revenue recognition principle, which we'll talk about here in a minute. And expenses are going to be driven by the expense recognition principle. And again, we'll talk about that here in a minute. It's important to note that revenue under an accrual basis accounting is not necessarily cash. It could be related to the timing of cash, but it doesn't have to be. The timing of when cash goes in or cash goes out is separated from revenues and expenses being recorded on the income statement under accrual basis accounting, as cash basis accounting is completely driven by the timing of cash receipts or cash payments as it relates to revenues and expenses. You could say that the ultimate goal of an external user with financial information is to determine whether or not a company is going to make money in the long term. Keep in mind that the goal of financial statement information is to be usable to the decision maker. And so ultimately, if we're trying to predict whether or not a company is going to, in the long term, be cash flow positive, the financial statement information in the short term have to help us have that predictive or confirmatory value when a financial statement user looks at the information. The problem that we run into is that while our goal is to determine long-term cash flow from a company, we must use short-term information in order to confirm or predict that long-term outcome. And cash basis accounting in the short run does not do as good of a job as accrual basis accounting in giving us that predictive value. Your book gives us an example of an app development company who also provides consulting services. They look at the situation where consulting services are provided in one month, but then are paid for in the following month, meaning that the company sold consulting services, but doesn't receive the money of providing those consulting services until the month after the consulting services are actually done. In this instance, if we first go on cash basis accounting, notice what happens. In this first month, we pay our workers to provide the consulting services, so cash goes out, but we don't actually receive payment for the consulting services that we provided because those services are provided on credit, something very common when you have business-to-business transactions. And so our income statement essentially, remember revenues minus expenses and net income, essentially it shows a net loss in the first month of $10,000. Notice then what happens in month 2. Assuming no other services are provided, we get paid in the following month $15,000 for the consulting services that we provided in the last month, have no other expenses because we assume no other transactions took place, and we show a positive net income of $15,000. So in month 1, we have a loss. In month 2, we have a profit. But understand what we're trying to do as an external user of the financial statements. We're trying to use information that's historical, like for instance, month 1, to help us predict month 2. But notice on a cash basis perspective, because businesses often operate with credit, we can't do that, or at least we can't do it as well. But if we utilize accrual basis accounting, which separates revenues and expenses from the timing of cash, we can actually better predict the long-term cash flow of a company, which is our ultimate goal as an external user. In this second analysis of the exact same information, but this time using accrual basis accounting, where this previous one uses a cash basis accounting, we can see that we're able to match the revenues from providing goods and services with the expenses or the cost it took to provide those goods and services. Notice that even though cash was not collected until the following month, we still record revenue under an accrual basis accounting in month 1 because that's when the performance obligation or the goods or services were provided to the customer. And then the expenses that it took to provide those goods and services are then matched with those revenues in the same month, thereby showing a net income that has more usable value that we can then predict in the future. Now again, assuming that there's no other transactions in month 2, we wouldn't be able to use this to say, oh, month 2 is definitely going to be 0. But what we would be able to do is use this information to say when services or goods are provided, this is what we should expect as the net result. And that's why it has more predictive or confirmatory value. But if we're not using cash in order, or at least cash timing, in order to determine when revenues and expenses take place, you might be wondering, how did we know to record the revenue or the expense in that month 1? And that's where it leads us to a conversation about the revenue and expense recognition principles. The revenue recognition rules have actually gone through a revision in the last couple years in financial accounting. We now follow a 5-step process that I have outlined right over here, where we identify the contract, which can be written, verbal, implied. We then identify the performance obligations. Is there one performance obligation within the contract, or is there multiple? We then determine the transaction price associated with the contract and allocate the transaction price among the various performance obligations, and then recognize the revenue when the performance obligation is satisfied. Now, this can bring up some complexities when we talk about intermediate accounting concepts. For instance, let's say you went out to buy an Xbox or some sort of gaming system. And when you paid a single price for this Xbox or gaming system, you received not only the system, but also access to their internet platform where you can play games online. You pay a single transaction price, but within that contract, is there one performance obligation, or is the company actually required to perform more than one performance obligation? And if so, since you paid a single transaction price, how much should be allocated to the console, the gaming console itself, and how much should be allocated to your access or usage of the platform where you play the games online? And these types of questions can bring up complexities, and it can get a lot more complex than just that for us when we're following this new set of revenue recognition principles. But for us, in this introductory class, most of the obligations that we're going to have are going to be a single obligation that's going to be performed, and therefore the transaction price associated is going to be allocated only to one item, and therefore it's going to make the recognition a lot easier. Ultimately, our goal is going to be to record revenue when provide a good or service. which ultimately this good or service is going to be our performance obligation. So ultimately we record revenue when we complete our performance obligation, and the amount that we record it for is the amount that we believe we're entitled to receive, or in other words, the transaction price, so long as we expect that we're going to receive payment. And this kind of alludes to a discussion that we're going to have in Chapter 8 about bad debt expense. But for right now, we'll hold off on that, and we'll just say we're going to record revenue when we provide a good or service, or in other words, when we fulfill our performance obligation. But because the timing of cash and the timing of when we record revenue doesn't necessarily have to coincide, we could have 3 different scenarios related to cash and revenue in which cash is recorded before, after, or at the same time as revenue. In order to make this more clear, let's look at a quick timeline here. I'm going to put cash on top, and then revenue on bottom. And then right here in the middle, I'm going to go ahead and note that this is where we complete the performance obligation. Okay. All right, scenario number 1 is going to be where we receive cash, we being the company, receive cash prior to actually completing the performance obligation, providing the good or service. In that case, our journal entry would be debit cash. We don't have a choice for that. We have a transaction. But our credit won't be to revenue. Remember, we won't record. Record implies that we're writing it down as a journal entry. We won't record revenue until we actually complete the performance obligation. So instead, we will credit the deferred revenue. Deferred revenue is actually a liability. Specifically, it's a current liability. And this implies that we still have an obligation. Our obligation is to fulfill the good or service. So this happens right here at this point in time, which we receive cash. Later on, we will actually fulfill our performance obligation. And when we do, our journal entry to reflect that is for us to debit deferred revenue, which would decrease the current liability, and then credit whatever type of revenue it is that we're doing. So we'll put a blank here and we'll say revenue. That could be service revenue, it could be sales revenue for providing a good, but this will increase a revenue account, which increases stockholders' equity account. Okay, that's scenario number 1, in which we receive cash prior to actually performing the performance obligation. Scenario number 2 is when we receive cash, we being the company, receive cash the same time we perform our performance obligation. In other words, we provide the good or service. Our credit is then going to be to a revenue. So again, if it was a service, we'd credit service revenue. If it was rent, where we loaned out space, we would credit rent revenue. Or if we provided a good, it would be sales revenue. And this, again, increases the revenue account, increasing stockholders' equity account. The third scenario is where we receive cash after having provided the good or service. Journal entry at this time period, where the 3 is, would be to debit cash. This is where we actually receive cash. Our credit, though, we're going to have to figure out by first going back to the point at which we perform our performance obligation, in other words, provide the good or service. Notice there's always a journal entry when we complete our performance obligation. We always credit revenue every time we complete our performance obligation. So we know back here at this point, there's going to be 2 journal entries required with scenario number 3. We know we're going to credit revenue because we always do when we have a performance obligation. Increasing revenue, increasing stockholders' equity. But at that point, we haven't yet received cash. In other words, in this scenario, we receive cash afterwards. So we can't debit cash. Our debit then goes to accounts receivable, which is a current asset. And this represents the right to receive cash. So once we complete our performance obligation, we then have the right to receive cash, even if we haven't got cash yet. And then when we go to 3, it becomes pretty clear that once we receive the cash, we then no longer have the right to receive cash because we've already received it. So our credit then is to accounts receivable to decrease this current asset here. And then our increase in cash increases that current asset. That's our third scenario. Okay, we can do a similar exercise with expenses here. We draw our timeline here, and we've got cash and we've got expense. But instead of noting a performance obligation, we'll say this is when we incur the expense. expenses, if at all possible, attempt to match or follow the revenue. In other words, as we looked at over here on the accrual basis accounting, what we tried to do is match the expenses or the costs with the revenues that were generated from taking on those costs. That's what made net income a usable number. And so we often say that expenses follow the matching principle, in which we attempt to match the expenses with the revenues that the expenses help generate, right? If we can't follow the matching principle, we ask ourselves the question, when was the economic benefit of the expense used up? In other words, when did the underlying business activity take place? So when did we get the benefit of the expense if we can't match it directly with the matching principle? And that's what guides our recording in accrual basis accounting for an expense. In other words, these two represent the incurrence. So we'll say whenever we incur, we're going to record an expense, just like whenever we perform the performance obligation, we recorded a revenue. We're going to increase expenses with a debit, whereas we increased revenues with a credit. The first scenario, scenario number one, says that we paid cash before we incurred the expense, before one of these two things over on the right-hand side happened. So we have to record a journal entry because we paid cash, and a payment of cash affects the accounting equation. So since our accounting equation is impacted, we don't have a choice. We have to record a transaction. But the debit won't go to an expense because we did not incur the expense yet. So instead, we have to record an asset. And depending on what it is, we'll say in this example, we purchase supplies. We record an asset while we wait to utilize the expense or incur the expense in a future period. Once we use up our asset, our supplies, so in this example, when we get to the incurrence piece, we've now used supplies, we have another journal entry. Remember, we'll record an expense, increase in expense, but decreasing stockholders' equity. Namely, if we're using supplies, our type of expense is going to be supplies expense. We record supplies expense when we use up the supplies, and then our credit obviously is to supplies because we're using it up. By crediting this asset, we are decreasing the current asset. And that would be our journal entry if we paid cash prior to the usage of the asset that we paid cash for. Okay, scenario number two would be where we incur the expense at the same time we pay for the expense. So in other words, if we bought supplies and used them right away, we could debit supplies expense. Another common one is rent, so we'll change it up and we'll say rent expense. So we pay for the rent and use it in that same month. So we debit rent expense. This increases the expense, decreases stockholders' equity, and credit cash, which decreases current asset. And that would be our journal entry if we incur the expense at the same time we actually pay for it. But remember, it's not the timing of cash that drives the recording of the expense. It's the incurrence of the expense. The third scenario is where we pay for our expense after we've utilized the expense, after we've incurred that cost. So in this third scenario here, we're going to credit cash, but our debit won't be to an expense. Instead, we record the expense whenever we incur that cost. So we know our expense is going to be over here. We'll use the example of, let's say, advertising expense. So we pay for advertising expense after, for instance, we run a billboard or run a newspaper ad or an online ad. So at the point at which we incurred the cost because we utilized the benefit of the advertising, right, then our expense increases, stockholders' equity decreases, but we don't pay for it immediately, so we're going to credit accounts payable. Again, purchasing this on credit. So our credit to accounts payable increases a liability. Then once we get to the timing of cash flow over here, we pay for the expense that we used already, and our debit then is going to go to accounts payable, decreasing that current liability. So far, what we've learned then is that the operating cycle activities are the primary sources of revenues and expenses which show up on the income statement. When measuring revenues and expenses, we could decide between cash basis versus accrual basis. But in a GAAP world, financial accounting world, GAAP only allows accrual basis accounting. The reason why is that on a short-term basis, accrual basis accounting provides better predictive and confirmatory value for the long-run goal role of determining whether or not a company is going to make money. When we operate on accrual basis accounting, we follow the revenue and expense recognition principles. The revenue recognition principle has recently gone through some changes and now follows a 5-step process. We're primarily in this class, an introductory class, going to be focused on the performance obligation and when that was actually completed. We then follow the same type of rules that we learned in the accounting cycle from chapter 2, but this time we're focused on revenues and expenses. Remember, revenues and expenses exist on the right side of the accounting equation. So if we were to label this out, notice that we have both revenues and expenses right here on the right-hand side. Remember that the right-hand side of the equation in total increases with a credit, okay? But since expenses are in brackets here, they're actually going to increase with a debit. That makes sense because if we were to increase an expense, that decreases net income, decreasing retained earnings, and decreasing stockholders' equity. In other words, we still increase the right-hand side of the equation with a credit. Plus, to increase revenues, we credit, and to increase expenses, we debit. Remember, each of these can have 3 different scenarios due to the timing of cash receipts and revenues and cash payments and expenses. Ultimately, when we record the accounting impacts of revenues and expenses, we create the foundation for the income statement.